If you locked in a mortgage rate under 2% back in 2021, the last few years have probably felt like a quiet win. Rates went up everywhere else, and your payment barely moved. That feeling is about to run out. This year, close to 1.8 million homeowners across the country are watching their fixed deal come to an end, and for someone with a typical remaining balance of £250,000, the numbers are not gentle. Move from a 2% rate onto where rates sit now, and you are looking at tens of thousands of pounds more in interest before that new deal is finished. The standard advice everywhere is the same. Call a broker, remortgage, get on with your life. For most homeowners, that still works. But if you are somewhere in that stretch between 55 and 65, the advice leaves out the one detail that actually decides whether you get approved at all. A 35-year-old applying for a new mortgage only has to explain this month's payslip. You have to explain what your income looks like 10 years from now because the lender is required to check it. That single difference is what turns an ordinary remortgage into what some lenders quietly treat as an affordability problem, and it is catching people who have never missed a payment in their life. I've watched this catch people who did everything right. Good job, clean credit record, years of on-time payments, and they still hit a wall the moment the bank looked past their current salary. Today I want to walk through why that happens, and 3 ways people in this exact position are working around it. One's a standard broker conversation usually skips. If you are in that stretch before retirement and want to protect your home without draining everything you have saved, stay with me. This channel exists to work through the numbers that actually apply to your stage of life. Here's a number worth sitting with. The average rate homeowners fall onto when they do nothing is currently 7.13%, and it applies the day your old deal ends, whether you were ready for it or not. Take a mortgage of £200,000. At 2%, the monthly payment sits around £847. Let that same mortgage slide onto today's average standard variable rate, and the payment jumps to about £1,430. That is £583 more every single month just for missing the window. You might assume a clean payment record protects you from any of this. It does not. If you want to switch to a new lender for a better rate, you have to pass a fresh affordability check, and that check is where age quietly starts to matter more than income. Here is the mechanism behind it. When a lender assesses your new mortgage, they are required to look at the lowest income you are likely to have across the full term of that loan, not your current salary. If your mortgage term runs past 67, which is now the state pension age for a growing share of homeowners, the lender has to stress test your application against your pension income, not the £50,000 you might be earning today. A pension income that could be half your salary, sometimes less, becomes the number your whole application rests on. That is the affordability trap. It has nothing to do with how responsible you have been with money. It comes from a rule built for someone with 30 working years still ahead of them, applied to someone with 5 or 10. The lender is not trying to catch you out. They are following a responsible lending rule written for a much younger borrower, and nobody adjusted it for you. Think about what that means in practice. 2 neighbours, same street, same £200,000 balance, same spotless credit history. One is 38, the other is 58. The 38-year-old gets approved in a week. The 58-year-old gets asked for a pension forecast, an estimate of retirement date, sometimes a letter from an employer confirming when they intend to stop working. Nothing about their behaviour changed. Only their age did. UK Finance has confirmed that around 1.8 million fixed deals are expiring this year, and industry reporting on so-called mortgage prisoners points to a growing group of homeowners who cannot move to a cheaper deal even though they can clearly afford their current payment, simply because they no longer pass the newer, stricter test. The Financial Conduct Authority has acknowledged the problem publicly, though the rules that create it remain in place. So what do you do if the bank says no? Most people panic and just stay on that 7% rate, assuming there is no other option. But there is a specific way to use money you already have sitting inside your pension that can lower this risk if you avoid one very common tax mistake first. Say you built up a pension pot of £200,000. Under current rules, you can take £50,000 of that completely tax-free. The obvious move looks like clearing debt with it. But the math is not quite as simple as it first appears. Put that £50,000 straight onto a mortgage sitting at 5.5%, and you save £2,750 a year in interest. Leave it invested instead, growing at a modest 5%, and it earns you roughly £2,500 a year. On paper, those two numbers sit close enough that most people just go with whichever feels safer, and clearing debt usually wins that instinct. Here is what the clear the debt crowd misses. If you use that lump sum and then need to pull more money out of your pension later to cover higher mortgage payments, or simply to top up everyday spending, you run straight into a second problem, one that has nothing to do with interest rates at all. The personal allowance, the amount you can earn before paying any income tax, is frozen at £12,570. The full new state pension now pays £12,547 a year. That leaves a gap of only £23. Almost every pound of private pension income you draw on top of your state pension gets taxed at 20%, sometimes 40%, if you draw a larger amount in one go than you meant to. Picture drawing an extra £5,000 from your pension to cover a mortgage shortfall. Once your state pension has used up nearly all of your tax-free allowance, that £5,000 could lose £1,000 or more to tax before it even reaches your current account. The mortgage saving from the lump sum looks solid on the day you make it. The tax cost only shows up later, quietly, on money you never even planned to touch yet. I used to tell almost everyone to clear their mortgage first, for the peace of mind alone. These days I am more careful with that advice. With the state pension now sitting so close to your full tax-free allowance, pulling extra money out of a pension to cover a mortgage payment and losing a fifth of it to tax in the process is a mistake I have watched quietly damage a retirement that otherwise looked fine on paper. The long-term cost here is invisible on the day you take the lump sum. It only appears 3 or 4 years later, when you need more income than you planned and discover how little of it you actually keep. None of this means the lump sum is always the wrong move. Sometimes clearing a chunk of debt genuinely is the right call, especially if your pension is large enough that the extra withdrawals barely touch the tax-free allowance in the first place. The point is not to avoid the lump sum. It is to run the tax math before you touch it, rather than assuming clearing debt is automatically the safer choice just because it feels that way. If the lump sum math does not clearly favor you, the next question is obvious. How do you handle a mortgage that might still be running when you are 80? That is where 3 specific routes come in, and most brokers only ever mention one of them. Meet someone I will call David, 61 years old, with £120,000 left on his mortgage. His 5-year fix at 1.8% is about to end, and his current lender will not offer him a new 15-year fixed deal, because by the time it matured he would be 76, well past the point his current income can be verified against. David has 3 real options in front of him, and none of them is the standard remortgage a broker would first suggest. His story is common enough that if it sounds familiar, that is not a coincidence. It is what happens to almost anyone whose mortgage term quietly runs past the age their income is expected to change. The first is a retirement interest-only pivot. Instead of a normal repayment mortgage, he switches to a deal where he only pays the interest each month, and the loan itself gets repaid when the house is eventually sold. On his balance, that drops his monthly payment from around £950 down to roughly £550. There is no fixed end date attached to the loan itself, which is exactly what solves his age problem with the lender. The trade-off is that the £120,000 itself never shrinks month to month, it simply waits, quietly, until the house is sold. The second is a term extension paired with a break clause. David negotiates with his existing lender to stretch the mortgage term out to age 75, lowering the monthly payment immediately, while agreeing with himself, not the bank, that he will downsize the property around age 70 and clear what is left then. This buys breathing room now in exchange for a firm decision he has to actually keep later. The third is a modern lifetime mortgage used as what I would call a hybrid, not a last resort. Instead of using it to fund lifestyle spending, David uses it specifically to ring-fence the remaining mortgage debt, so no monthly payment is required at all, which frees up his other income for actual living costs instead of debt service. The interest on this kind of loan compounds over time, so it works best as a deliberate, calculated choice rather than something reached for in a panic. Look at what these routes do to his monthly disposable income. Stay on the standard variable rate after the fix ends, and David is left with around £400 a month once the mortgage is paid, barely enough to cover council tax and a rising energy bill without dipping into savings. Take the interest-only pivot instead, and that number roughly doubles to around £800, enough to actually breathe. None of the three routes suits every situation. The interest-only pivot works best if you already have a plan for how the loan gets repaid eventually, usually the sale of the house. The term extension works best if downsizing at a later age genuinely appeals to you rather than feeling like a last resort. The lifetime mortgage hybrid works best when protecting monthly cash flow matters more to you than what is eventually left for anyone inheriting the property. These routes only work if David acts before his current deal actually ends, not after he has already fallen onto the higher rate. But even a solid plan can get knocked off course if conditions shift again, and it helps to see exactly what that looks like. Picture two very different versions of the same homeowner, both facing a mortgage renewal in a year where rates stay higher for longer, right around the time the cash ISA rules change. From the 6th of April 2027, the amount you can put into a cash ISA each year drops to £12,000 if you are under 65, down from the wider allowance most people are used to relying on. That is not a small technical detail if a cash ISA happens to be where your emergency buffer lives, the same pot you would normally raid to cover a mortgage shortfall or an unexpected car insurance renewal. The unprepared version of this homeowner waits until the week their deal expires to even start the remortgage conversation. They fail the new affordability test, drop onto the SVR near 7%, and end up raiding an ISA that now holds less room to rebuild than it used to. Every pound they pull out this year is a pound they cannot simply replace next year under the old, more generous limit. On top of the mortgage shock, they are now managing a shrunken safety net at exactly the moment they needed it to be bigger, not smaller. The prepared version does one simple thing differently. They use what I think of as the 6-month rule, locking in a new rate roughly 180 days before their current deal ends. If rates drop in the meantime, most lenders let you switch to the cheaper option before completion. If rates rise instead, you are already protected at the number you locked in. Either way, the decision gets made calmly, months in advance, instead of under pressure in the final week. The goal behind all of this is not paying off the mortgage as fast as humanly possible. It is what I call the resilience path, getting to a point where your mortgage payment sits under 30% of your total retirement income. So one bad renewal year, one rate rise, one slow remortgage application cannot knock your whole plan sideways. Ask yourself honestly which version of that homeowner you currently are right now, not which one you intend to become eventually. There is one thing that still stops most people from moving toward the prepared version, and it has nothing to do with numbers. It is the fear of never fully owning the place you have lived in for decades. There is a specific kind of pride in paying off a mortgage, and it runs deep for this generation. For most of your life you have been told, directly or indirectly, that debt is something to escape as fast as possible. In retirement, that belief can quietly work against you. It makes sense where it comes from. Watching your parents pay off their home and finally relax probably shaped how you think about this too. but your parents likely had a final salary pension behind them and savings accounts paying closer to 10%. Neither of those exists in quite the same way now, and treating their playbook as your own can leave you holding all your wealth in one place that you cannot easily reach. The shift worth making is not about owning the bricks faster. It is about owning your time. If keeping a small, manageable mortgage lets you hold on to £100,000 in accessible savings for whatever life throws at you, you are often in a safer position than someone sitting in a fully paid-off house with almost nothing left in the bank. I remember a neighbour who was so proud the day he made his final mortgage payment. 6 months later, his boiler failed in the middle of winter, and because every pound he had was sitting inside the walls of that house, he ended up taking out a high-interest personal loan just to fix it. Being mortgage-free did not protect him. It just moved where his risk was hiding, from a monthly payment he could plan around to an emergency he could not. Ask yourself which version of safety actually matters more to you, a paid-off house on paper or the ability to cover a broken boiler, a car repair, or a leaking roof without borrowing at a high rate to do it. Most people never get asked to choose between the two until something like a boiler picks the moment for them. So here is where that leaves things. The 2026 mortgage renewal wave is real, but if you are between 55 and 65, it was never simply a question of the interest rate. It is a question of what a lender decides you can afford once your income changes shape, and what you decide to do about it before that decision gets made for you. Check exactly when your current deal ends. Look seriously at retirement interest-only options if a standard remortgage keeps getting refused, and do the tax math properly before you touch a pension lump sum to pay down debt. None of these three routes suits everyone. What matters is knowing they exist before you find yourself stuck on a 7% rate with no plan. If you want help thinking through the ISA changes coming in 2027 alongside the squeeze on your personal allowance, stay subscribed. This channel is built around making sure your retirement gets shaped by your own decisions, not by whatever affordability test your bank happens to be running that particular year. None of this needs to feel like a crisis. It is a set of decisions you can make calmly, months ahead of your renewal, once you know which questions to actually ask your lender. Stay calm, do the actual math before you decide anything, and I will see you in the next one.